Customer lifetime value, abbreviated CLV, is the total profit a company expects to earn from a single customer over the entire time that the customer stays with the brand. Think of a customer as a tree. The seed first purchase is planted, and each year the tree gives fruit future purchases. The CLV tells you how much fruit you can count on from that tree before it withers. Strategically, CLV helps managers decide how much to spend on acquiring or keeping customers, which product lines deserve more marketing dollars, and where to focus service improvements. High CLV customers are like premium seats in a theater. They deserve the best service because they bring the most revenue over time. In marketing management, CLV aligns marketing spend with long-term profit, not just short-term sales. Guide segmentation. High CLV segments receive loyalty programs. Low CLV segments may be targeted with cost-efficient promotions. Informs pricing and product development by showing which customers stay longer and spend more. Provides a single comparable metric across channels: online, offline, subscription, retail. Explanation: every CLV calculation rests on a set of assumptions and variables. The most common ones are average purchase value, abbreviated a PV, the mean amount a customer spends per transaction. It assumes past purchase sizes are a good proxy for future ones. Purchase frequency, abbreviated F, how often the customer buys in a given period, for example purchases per month. It presumes buying cycles are relatively stable. Gross margin, abbreviated M, the profit margin on each sale, revenue minus cost of goods sold divided by revenue. It converts revenue into profit. Retention period, abbreviated R, the expected number of periods the customer will stay active, often expressed as an average lifespan in years or months. Discount rate, lowercase d, the cost of capital or required rate of return that reduces future cash flows to present value. It reflects the time value of money. Churn probability, lowercase c, the chance a customer will stop buying in a given period. When churn is not constant, survival curves or Markov transition probabilities are used. Customer acquisition cost, abbreviated CAC, the expense incurred to win the customer, advertising, sales, labor, onboarding. CAC is subtracted from CLV to obtain net CLV. Core assumptions include: A. Past behavior is indicative of future behavior. B. Margins stay roughly constant. C. The discount rate is appropriate for the firm's risk profile. And D. The customer base is large enough that averages are meaningful. Violating any of these can lead to biased CLV estimates. The simplest historical CLV formula multiplies 4 building blocks. CLV hist equals a PV times F times M times R. A PV equals average purchase value, for example $120 per order. F equals purchase frequency per period, for example 4 purchases per year. M equals gross margin, for example 30% or 0.30. R equals retention period in years, for example 5 years. Numerical examples. A mid-range clothing retailer finds that a typical customer spends $120 on each visit, shops roughly 4 times a year, and the average gross margin on apparel is 30%. Customer-level data shows that, on average, a shopper stays with the brand for 5 years. CLV hist equals 120 times 4 times 0.30 times 5 equals $720. Interpretation. Over the next 5 years, the retailer can expect to earn about $720 of profit from an average customer, before accounting for acquisition costs or the time value of money. This back-of-the-envelope figure is useful for quick budgeting and for comparing segments. Why it works. The formula treats every year as identical, same a PV, same F, same M, and assumes the customer will survive the whole R years. It is easy to explain to senior managers because it uses familiar concepts: price, frequency, margin, years. Explanation. When money is earned in the future, it is worth less today because of the opportunity cost of capital. The discounted cash flow DCF approach converts each future profit stream into present value terms. General DCF CLV formula. CLV DCF equals the sum from T equals 1 to T of APV sub T times F sub T times M sub T divided by 1 plus D to the T, where T equals period, usually year. T equals expected lifetime in periods, and D equals discount rate expressed per period. Worked example. A SaaS firm estimates the following for a typical subscriber. Year 1 APV $200, frequency 1, gross margin 0.7, profit 140. Year 2 APV $210, frequency 1, gross margin 0.7, profit 147. Year 3 APV $220, frequency 1, gross margin 0.7, profit 154. Year 4 APV $230, frequency 1, gross margin 0.7, profit 161. Year 5 APV $240, frequency 1, gross margin 0.7, profit 168. Assume a discount rate of 10% per year, D equals 0.10. PV1 equals 140 divided by 1 plus 0.1 to the 1 equals 127.27. PV2 equals 147 divided by 1 plus 0.1 to the 2 equals 121.49. PV3 equals 154 divided by 1 plus 0.1 to the 3 equals 115.9. PV4 equals 161 divided by 1 plus 0.1 to the 4 equals 110.58. PV5 equals 168 divided by 1 plus 0.1 to the 5 equals 105.51. CLV DCF equals 127.27 plus 121.49 plus 115.9 plus 110.58 plus 105.51 equals 580.75. So after adjusting for the time value of money, the SaaS firm expects to earn about $581 in present value profit from a typical subscriber over 5 years. Key takeaways. The DCF method reduces CLV when the discount rate is high or the customer lifespan is long. It allows comparison of CLV across businesses, with different cash flow timing, for example subscription versus one-off sales. The formula can be programmed easily in Excel using the NPV function or in any statistical software. Explanation: simple historical CLV assumes the same profit each year. In reality, customers move between states: active, churned, reactivated, with probabilities that change over time. Two advanced ways to capture this are Markov chain models and survival analysis models. 1. Markov chain CLV. A Markov chain describes the probability of moving from one state to another in each period. Suppose we have 3 states: active, inactive, and churned. Transition matrix P equals open bracket 0.80, 0.15, 0.05 close bracket, open bracket 0.30, 0.60, 0.10 close bracket, open bracket 0.00, 0.00, 1.00 close bracket. Rows sum to 1. For example, an active customer has an 80% chance of staying active next month, 15% chance of becoming inactive, and 5% chance of churning. Assume profit per active month equals $20, profit per inactive month equals $5, perhaps a low-frequency upsell, and churn yields $0. Let R be the reward vector open bracket 20, 5, 0 close bracket. The expected discounted CLV over infinite horizon with monthly discount rate D equals 0.01 solves. V equals R plus open bracket 1 divided by open bracket 1 plus D close bracket times P times V. Rearrange. V equals open bracket I minus open bracket 1 divided by open bracket 1 plus D close bracket times P close bracket inverse times R. Computing using a calculator or Excel gives V sub approximately $1,150. This is the present value profit for a brand new active customer. 2. Survival analysis CLV. Survival analysis treats churn as a failure time. Assume the monthly churn hazard follows a Weibull distribution with shape K equals 1.2 and scale lambda equals 12 months. Survival function S of t equals exponential of negative open bracket t divided by lambda close bracket raised to the power k close bracket. Expected profit per month equals $20. Discount factor per month equals 1 divided by open bracket 1 plus d close bracket to the power t, with d equals 0.008, approximately 10% annual. CLV equals the sum from t equals 1 to infinity of 20 times s of t times 1, divided by open bracket 1.008 close bracket to the power t. Evaluating the sum to 60 months practical truncation yields roughly $1,030. Sample calculation summary Markov chain CLV $1,150 captures state switching survival CLV $1,030 captures varying churn hazard. Both are higher than the simple historical CLV $800 because they account for the chance of ray activation and for the fact that early months contribute more profit. Practical tip for MBA students: build the transition matrix in Excel. Use MMULT and MINVERSE to solve the linear equation, or use a statistical package R or Python for survival curves. Customer acquisition cost, abbreviated CAC, is the money spent to win a new customer. Net CLV tells you the actual profit after you subtract what you had to spend to get the customer. Net CLV equals CLV minus CAC. A fast food chain runs a $30 promotional campaign to attract a first-time buyer. The average historical CLV profit of a new customer is $90, computed using the simple formula. CAC equals $30. Net CLV equals 90 minus 30 equals 60. Thus, the chain earns $60 profit after accounting for the marketing spend. Now compare two channels. Channel CAC estimated CLV net CLV. TV ads $40, $85, $45. Social media $20, $70, $50. Even though TV ads bring a higher raw CLV, $85 versus $70, the net CLV is lower because the acquisition cost is higher. The firm should shift budget toward the channel with the higher net CLV. Strategic implications. Net CLV is the metric that directly ties marketing spend to profit. If net CLV is negative, the company loses money on each new customer and must either lower CAC, better targeting, or improve retention or margin. Net CLV can be used to set break-even CAC. CAC break equals CLV. Any CAC above that point makes the acquisition unprofitable. In budgeting, firms often allocate a percent of net CLV to CAC. For example, spend no more than 30% of CLV on acquisition. MBA perspective. When presenting a business case, always show both CLV and net CLV. Decision makers will ask what's the payoff after we spend on marketing. Net CLV answers that directly. Explanation: sensitivity analysis explores how customer lifetime value changes when key inputs vary. It helps managers understand which levers are most important and plan for best case, worst case, and most likely scenarios. Key variables to test. Number 1, retention period, represented by R or churn rate. Number 2, gross margin, represented by M. Number 3, discount rate, represented by D for discounted cash flow customer lifetime value. Number 4, customer acquisition cost, CAC, if calculating net customer lifetime value. Example: simple historical customer lifetime value. Base case: average purchase value equals $120, purchase frequency equals 4 per year, margin equals 30%, 0.30. Retention equals 5 years, therefore customer lifetime value equals $720. Retention 3 years with margin 20% gives $288, margin 30% gives $432, margin 40% gives $576. Retention 4 years gives $384, $576, and $768 respectively. Retention 5 years base gives $480, $720, and $960 respectively. Retention 6 years gives $576, $864, and $1,152 respectively. Retention 7 years gives $672, $1,008, and $1,344 respectively. Interpretation: a 10% increase in margin raises customer lifetime value by $240, which is 33% of the base. Extending retention by 1 year adds $144, which is 20% of the base. Example: DCF customer lifetime value sensitivity. Base discounted cash flow customer lifetime value from earlier example equals $581 using discount rate 10%. Vary discount rate and retention. Discount rate 5% with 3-year retention gives $680. 5-year retention gives $820. 7-year retention gives $950. Discount rate 10% base gives $530, $581, $628 for 3, 5, and 7-year retentions respectively. Discount rate 15% gives $420, $460, $495. Discount rate 20% gives $350, $380, $410. How to present. Use tornado charts to visualize which variable moves customer lifetime value the most. Highlight the break-even customer acquisition cost line on the net customer lifetime value table. Run Monte Carlo simulation, for example 10,000 draws, to produce a probability distribution of customer lifetime value and report the 5th, 50th, and 95th percentiles. Takeaway for managers. Sensitivity analysis shows that investing in retention programs, which lengthen retention, often yields a larger customer lifetime value boost than modest margin improvements, especially when discount rates are low. Explanation. Below are typical exam-style questions that test both theoretical understanding and practical computation of customer lifetime value. Sample answers give the key points an MBA a student should include. Question 1. Derive the simple historical customer lifetime value formula from first principles and explain each component. Start with profit per transaction equals average purchase value times margin. Profit per period equals average purchase value times margin times frequency. Over a retention horizon of R periods, total profit equals average purchase value times margin times frequency times R. Rearrange to average purchase value times frequency times margin times R. Explain that average purchase value reflects spending size. Frequency captures how often the customer buys, margin converts revenue to profit, and R is the expected number of periods the customer stays. Question 2. A retailer records the following data. Average order value $80, purchases per year 5, gross margin 25%, average customer lifespan 4 years. Compute customer lifetime value using the simple formula and interpret the result. Customer lifetime value equals 80 times 5 times 0.25 times 4 equals $400. The retailer can expect $400 profit from an average buyer over the 4-year relationship, before accounting for acquisition cost or discounting. Question 3. Explain why the discounted cash flow method is preferred over the simple historical method for a subscription business with a 10-year contract. Cash flows occur over many years. Time value of money matters. Discounting reduces the weight of distant cash flows, giving a realistic present value. Allows comparison with alternative investments that have known opportunity costs. Captures the effect of changing churn rates or price escalations over time. Question 4. Given a monthly churn probability of 2% and monthly profit $15, with a discount rate of 0.8% per month, compute the discounted cash flow customer lifetime value for an infinite horizon. Survival probability at month t equals 1 minus 0.02, raised to the power of t minus 1. Present value of profit at month t equals 15 times 0.98, raised to the t minus 1 divided by 1.008 raised to t. Customer lifetime value equals the sum from t equals 1 to infinity of 15 times 0.98 to the t minus 1 divided by 1.008 to t. Recognize as a geometric series with ratio r equals 0.98 divided by 1.008, approximately 0.972. Sum equals 15 divided by 1 minus r times 1 divided by 1.008, approximately 15, divided by 1 minus 0.972 times 0.992, approximately 535 times 0.992, approximately $531. Interpretation. Present value profit approximately $531 per subscriber. Question 5. A company acquires a customer at a customer acquisition cost of $120. The calculated discounted cash flow customer lifetime value is $100. Discuss the implication and propose 2 ways to improve net customer lifetime value. Net customer lifetime value equals 100 minus 120 equals negative $20. Negative. The acquisition is unprofitable. The firm loses money on each new customer. Ways to improve. 1. Reduce customer acquisition cost, refine targeting, use cheaper channels, negotiate media rates. 2. Increase customer lifetime value, improve retention loyalty program, raise margin price increase or cost reduction, cross-sell higher margin products. Question 6. Perform a sensitivity analysis on the simple customer lifetime value formula by varying the retention period 3 to 6 years while keeping other variables constant. Average purchase value $100. Frequency 3, margin 30%. Provide the resulting customer lifetime value range and comment on managerial relevance. Answer table. Retention years column and CLV column. Separator row. 3 years equals $270. 4 years equals $360. 5 years equals $450. 6 years equals $540. Comment, extending lifespan by 1 year adds $90.